This is Mark to Market, a podcast of BT correspondents.
Hello, everybody. I'm benpaul. Welcome to Mark to Market, a BT correspondence podcast. We're now halfway through what has been a very eventful year, and it feels like the appropriate moment to take a deep dive into the trends and headlines that have been driving the markets around the world. So joining me today in the BT podcast studio is Eddy Loh, the Chief Investment Officer for Group Wealth Management at Maybank. Eddy, thank you very much for being with us today.
Thanks for having me.
Eddy, there are a lot of topics and trends that I'd like to talk about today, and I would like for you to get us started with a big picture view, first of all, of how you and your team at Maybank analyze the markets and formulate your ideas for investors, but also how we got to where we are right now. Every major event over the past few years, from the pandemic to Trump's Liberation Day tariffs and his war in Iran, to the massive build-out of AI capacity, has felt like the beginning of some fundamental shift that ought to worry investors. Yet stocks in the US, Europe, Japan, and even here in Singapore are close to all-time highs. What are you and your team telling clients of Maybank to do right now? And what are investors most concerned about?
Well, I think as a start, I lead the CIO office. My team is responsible for forming the house views across major asset classes. And our job is really to combine macroeconomic analysis, trends, taking into account earnings projections, valuations, putting all together into asset allocation recommendations for our clients. And what you pointed out, yes, I think we have actually seen many events over the past few years. And most recently, some of the key concerns that have surfaced. Obviously, geopolitics. And we still don't know whether the US and Iran will indeed reach an agreement after the 60-day negotiation period. Secondly, with Kevin Walsh becoming new Fed chair and inflation higher, not just in the US, but also across other major economies, investors are also a little bit worried about central bank policies, whether instead of a rate cut, it will be a rate hike. And then last but not least, AI. AI rally has been going on for probably now is into its fourth year. So there are some concerns that is it going to become a bubble, like what we have seen in the late 1990s. We had the burst of the internet bubble. Some of these concerns are actually surfacing, but I think one of the key reasons that has been supporting the markets is really about corporate earnings. Corporate earnings have been very, very strong and solid. And that is the reason why we are still seeing markets hitting record highs. But what we also highlight to our investors and clients is do not overreact to every piece of news and headline, but rather focus on the macro fundamentals, focus on the long-term trends. I think that will do well for your portfolio in the long run.
Not to be argumentative, but I hear this a lot from analysts and fund managers and wealth advisors. Maintain a long-term mindset, stay invested through volatility and so on. But would you not agree that it's become harder to maintain a long-term view, given, for example, the more chaotic approach to policymaking in the US and the very big and rapid advances in technology that you just mentioned? Has this affected your clients' appetite for risk? And how are you managing that?
Yeah, indeed. The news flow often flip-flops, especially from likes of President Trump.
Yeah,
I think those can be pretty distracting and sometimes nerve-wracking.
yes.
Case in point, Liberation Day tariffs, S&P 500 correcting 20% within a short period of time. But the problem is, if you were to react to that piece of news, if you have sold everything during that time and never got back because you were just waiting.
You'd have been too afraid to jump back in.
Correct. You would have missed the subsequent rebound. That is one key example why we are suggesting to clients or investors to say not overreact to such news flow. But we do suggest them to keep a well-diversified portfolio. If you look at during that period, S&P 500 down 20%, but we run a balanced portfolio, mixture of equities, bonds, a little bit of gold, cash. The drawdown during the same period was less than 10%. So it made it easier for investors to stay invested during those volatile times. I think over time, our clients at least have learned perhaps that is the better way to approach investments rather than to really try to time the market, because timing the market very often has not been too effective.
But the thing about the big structural trends that we're dealing with right now is that their impact on the global economy and on markets has become quite hard to forecast and to discern. Just to take one example, artificial intelligence. Since OpenAI's ChatGPT went live in late 2022, the markets have been consumed by the AI theme. But at that moment, back in 2022, the Fed was raising interest rates very aggressively and markets were under pressure. And I think it wasn't clear to many people how large an impact all the spending on AI infrastructure was going to have on the global economy and on global markets. And the big question now seems to be whether these AI investments will actually pay off. I mean, that's another uncertainty. And that question is becoming increasingly important for investors because we're starting to see the big AI players like SpaceX and OpenAI and Anthropic going public, while the likes of Alphabet and Meta platforms have been exploring raising money from public investors. So what's your thinking about that structural trend, AI? Do you agree that forecasting the impact of that technology is not a very straightforward matter? And how are you positioning yourself?
I think the first point here is that AI is here to stay, just as internet is here to stay or has been staying
so it's
since the internet bubble.
It's a structural trend
it's a structural
in
trend.
that sense,
Correct.
But the impact of it.
I agree with you. It is actually difficult, especially during the early stages, to decide who will be the beneficiaries, who will be the winners, and who will be the losers. Even at this juncture, the key beneficiaries have been the infrastructure providers or CAPEX beneficiaries supporting the AI build-out.
Like the chip makers.
Chip makers. We have actually moved from NVIDIA's graphic chips. This year is all the memory guys. Because there was a shortage, there was a bottleneck. But 6 months, 12 months down the road, will they still be the bottleneck or will there be other bottlenecks? That is actually what we are trying to gauge. But beyond just these infrastructure providers or CAPEX receivers or beneficiaries, I think what is important here to note is when you want to invest in AI, it's not just about the upstream guys, these infrastructure providers. You do need to actually look across the value chain. Because at some point, those people that are making the AI investments, the hyperscalers, the platform guys, they will stand to benefit from the monetization of these AI investments. And we are actually beginning to see a little bit of rotation into that. And beyond that, the next phase will be ultimately the AI users, enterprises that are using AI to increase profits, increase productivity in many different sectors. That includes like the banks, healthcare companies, the non-tech sectors actually. What we are talking about here is, I think, 3 points. Firstly, people were focusing on beneficiaries of the AI build-out. Who is building the AI? Then the second phase is who will benefit from the AI monetization. But I think gradually we will also move into who are the most effective users of AI. When it comes to investments, we do need to make a conscious effort to broaden exposure across this whole value chain, rather than just focusing on semiconductors and chip guys.
So it sounds like there's different stages to this structural trend, and you've got to keep that in mind.
Yes.
Okay. Another big theme running alongside the AI story is geopolitics. Over the past year, we've heard a lot about the US restricting China's access to certain types of chips. On the other hand, China has shown the world that it has some leverage over the US when it comes to the supply of rare earths. We've also seen that Iran has the ability and the willingness to jam up the global supply of oil and fertilizers when it decides it wants to do that. And then there are the tariffs that the US has placed on most of the world, and its seeming ambivalence, shall we say, towards long-standing global security arrangements. Yet none of this has actually derailed the markets either. What are you advising your clients to do in relation to geopolitics? Where are the opportunities here?
Geopolitics, in some ways, will increasingly shape how we construct portfolios because of some of the structural trends, but it should not be the key factor that is driving our decisions. I think what's happening, say, for example, in the Middle East conflict, people start to be aware that if the Strait of Hormuz gets blocked again, then I will not get my supply of oil, fertilizers, gas. So it increased that urgency to build self-reliance. We have been talking about energy transition, energy security, but I think the Middle East conflict actually highlights the importance, I think increases the urgency for governments around the world to focus on that. I think the long-term trend of energy transition, reducing reliance on fossil fuels, I think that is a key trend that we are observing.
So renewable energy is a big driver.
Exactly.
Okay.
Other drivers, for example, defense.
Okay.
Right. The US is saying, I'm not going to be spending too much money. The rest of the countries, especially those in Europe, will have to increase their own defense spending to protect themselves. And we are seeing that Germany is talking about increased defense spending. Japan is also talking about increasing defense spending. I mean, it's not a good thing for people to go into war. But unfortunately, because of this increasing geopolitical fragmentation, where everybody has to fend for their own interests, that's another inevitable trend.
And it's proving to be a demand driver for the global economy.
because of the investments into defense, it will benefit certain sectors. And that's why we are actually noting that trend as well.
So not great for humanity, but not so bad for markets.
Not so bad for markets, right? But obviously, I do hope that we do not actually invest too much into defense because in terms of the economic multiplier, I think that remains a question as well.
Eddy, you've mentioned the importance of diversifying exposure across different markets. When President Trump unveiled his Liberation Day tariffs, some market watchers began talking about the Sell America theme. There was the sense that the US dollar would weaken and global capital would flow to Europe and Asia. And that has happened to some extent. Yet China has been a relative underperformer over the past year. What's holding it back in your view? Is its economy not performing up to expectations, or is it simply about its relative lack of AI plays?
Right. I think China has really moved through different stages since COVID. It rebounded together with the rest of the markets for a while. And then there was this prolonged lockdown and all this regulatory tightening on the tech sector that made the whole world say that China is uninvestable. And then we saw an about turn. Subsequently, China opened up. There was easing of those regulatory tightening, and then it became investable again. But this year, we saw China underperforming. Hang Seng Tech was also down almost 20% year to date, partly because of the earnings of the platform companies, which are major constituents of the Hang Seng Tech index, has been pretty lackluster. Some of the so-called sexier hardware semicon plays, they're actually not part of these offshore benchmark indices. So they have been doing quite well. The semiconductor, if you look at just China's semiconductor plays, they've been actually doing quite well, but it's not captured in the major indices. But moving forward, what we are looking at is, given the underperformance, given the attractive valuation, we thought that the risk reward is actually becoming pretty interesting. There are signs that the platform companies, they have been investing, but the earnings, there are signs that it's bottoming out. And there are also talks about some of these companies doing some restructuring, perhaps listing their AI-related plays to unlock shareholder value. That could actually give a boost to share prices as well. And some of the hardware or semiconductor plays could be also added into the indices that could actually create more excitement. But more importantly, Chinese markets are always somewhat pretty influenced by policies. It has been quite quiet on the policy front. The government doesn't see really an urgent need to give big bazooka policies to boost growth. Of course, I think if you look at year to date, the domestic consumption, I think, has been pretty soft still. China property sector is still struggling to see a meaningful recovery. But the export sector, some of the hardware tech exports, I think they have been chugging along quite nicely. We'll not be surprised to see some form of incremental policy support, be it on the infra investment side or even on consumption side. And if that were to come through, and we have a July Politburo meeting, and if we do get any incremental policy support, that could also help to lift a market sentiment.
Should China and Hong Kong stocks be a core holding for investors in this part of the region? It's a very important economy, but is the China market mature enough in a way for it to be a core holding for investors?
Where we position ourselves or allocate our investments, we actually use a strategic asset allocation framework to guide our investors. So, for example, if you're a balanced risk profile investor, we are recommending 48%, close to 50% equity exposure. And within this equity exposure, the key market exposure that we're talking about, US, Europe, Japan, and Asia ex-Japan. And then within Asia ex-Japan, Hong Kong and China, which accounts, I think, probably today about 20 to 30% of the Asia ex-Japan market weight. I think it is important to have at least some Hong Kong, China exposure, but it's important not to be overly exposed to a certain market, be it US, be it Hong Kong, China, or be it any other markets. Therefore, we have this asset allocation framework to guide us, to keep reminding us that, yes, I think certain markets may be more attractive at certain point in time, so you can tactically allocate a little bit more, but not too much.
The Mark to Market podcast will be back right after this.
Market Focus Weekly, now hosted by Howie Lim. A sharp weekly deep dive into what's moving markets in Singapore and across the region, with analysts and market insiders to break down the forces shaping the week ahead. New episodes every Friday, powered by the journalism of the Business Times. Find Market Focus Weekly wherever you get your podcasts.
And now, back to Market, a podcast of BT correspondents.
Welcome back. This is the Mark to Market podcast. I'm benpaul, speaking with Eddy Loh, CIO of Group Wealth Management at Maybank. Eddy, let's talk about risk management now. Investors are often advised to diversify risk by investing in non-correlated assets. And bonds have been the traditional asset class to which investors have turned to mitigate the risk of owning stocks. In recent years, however, investors have also looked to alternative risk diversifiers, in particular gold. But here's the thing. Since the end of 2021, the price of gold, even after falling significantly this year, is up about 120%. That's more than twice the S&P 500's gain of about 55% during the same period. Is gold a more effective risk mitigator compared to, say, US Treasury bonds? Or is it something that might actually add more volatility to one's portfolio?
I believe treasuries and gold play different roles in a portfolio. Traditionally, I think US Treasuries is a hedge against growth risk. When economy is not doing well, when there's recessionary risk, markets will be pricing in for eventual rate cuts, and that is actually beneficiary for bonds, beneficiary for treasuries. I think that still holds true. That instance where you saw equities and actually treasuries selling off together, that was, I think, 2022.
Yeah.
Where we had a surge in inflation, US CPI went up to 8-9%, and then it forced the central banks to hike rates.
And they both went in the same direction.
Exactly. So I think during that regime, yes, I think that correlation story, right, where you talk about diversification, I think that did not hold true. But in normal times, especially if you are going to hedge against growth risk, I think treasuries still play a role in mitigating downside risk. Now for gold, it's starting to take a different role now, especially after the Russia-Ukraine conflict in 2022, where Russian assets, US dollar assets in particular, were frozen. And you see central banks around the world starting to diversify their reserves.
Because they fear that it might happen to them.
Right, so into other assets, particularly gold. So gold purchases by central banks has been on the rise since 2022. In addition to that, I think there are talks about fiscal concerns around the world, especially in developed markets. Right, US obviously has been running very high debt levels. European selected markets like France, UK, there were also some fiscal issues. And that then brings about the question on fiat currencies. And gold, as an alternative to fiat currencies, I think that was another thinking behind the demand for gold, alongside, talks about dollar debasement because of reducing Fed credibility or government credibility. But having said that, sometimes when you have too much of a good thing, then it could also unravel. And we've actually seen a bit of that in gold, especially in beginning this year, when gold went up 10% in 3 days. And that's not normal, and that's speculative flows. So when there's speculative flows going to an asset class, even though traditionally it was meant to be a safe haven, but when you have all these huge flows coming in, abnormal flows coming in, then it makes it a little bit more risky, right? So we are seeing a little bit of reversing of these flows, which I think is healthy. And for us, down the road, gold has actually corrected more than 20% from their highs of 5,005, 5,006. Now it's hovering around 4,000. Maybe it will still stay around this range for some time. But in the medium term, we thought that dollar could soften a little bit. That could lead to gold restoring its upward bias. And more importantly, I think that sustained central bank demand. I think it is here to stay.
You talk about central bank demand for gold, but here's my problem with gold. It's not clear to me how to gauge the fair value for gold at any particular moment. All asset classes are subject to speculative flows, including US Treasuries. But there is a rate of return from holding that particular asset. You could figure out a rate of return for holding equities as well. How do you gauge the fundamental value for gold?
Well, you're right. It is a challenge. Obviously, one way is to say the cost of mining. How much does it cost to mine gold? So I think that provides a flaw, but I think it's really beyond that. It's really about that value, that diversification value that gold can provide. To me, it's more qualitative rather than quantitative. You can't run a DCF to gauge the fair value of gold. But if prices were to go up too quickly in too short a time, that to me is a warning sign. So for example, there are data to track speculative positioning for gold. When the positioning becomes a little bit too bullish, suggests that gold is being overbought, I think that's where we will be careful. But at this juncture, the reverse seems to be happening. It looks a little bit oversold. The positioning definitely has come off. This perhaps will be a better level to actually build some exposure into gold for its diversification benefits.
Can I bring you back to just the comparison between gold and US Treasury bonds? As you mentioned, gold is talked about in terms of the US dollar debasement trade because it's viewed as being immune to seizure by the US government. But does its growing popularity mean that US Treasury bonds are becoming less attractive to non-US investors? Are Treasury bonds still the appropriate risk-free benchmark for investors here in Singapore?
At this juncture, I think US Treasuries, there are still very little alternatives in terms of within the sovereign bond space. US dollar remains as the major currency now, and I think for the foreseeable future. So US Treasuries, hard to replace, but we do see a need for investors to diversify their exposure, not just in terms of asset classes, but also in terms of currency. So yes, I think you can have some US Treasuries, but take a look at our asset allocation framework. We have a certain allocation to US Treasuries. Keep within that limit and do not just keep within US dollar investments. Say fixed income. Traditionally, many investors say focus on US dollar bonds, but we do see opportunities in fixed income investment in other currencies. Sing dollar, for example, at the right time, Aussie dollar denominated bonds, Euro denominated bonds. I think those could actually come into play in the portfolio as well.
There seems to be a broad expectation that the Fed will raise rates this year, but you're expecting that the Fed will end up holding rates steady through to the end of 2026. What's behind that view? And it is, correct me if I'm wrong, but it is quite different from what the rest of the market is expecting right now.
Well, indeed, I think when you look at the beginning of this year, market was pricing 2 Fed rate cuts. And now it has shifted to almost 2 Fed rate hikes. And the first rate hike could come in as early as September. And this was really driven by the higher inflation that we are seeing. US CPI actually went up to 4.2% the last print, partly because of the higher oil prices due to the Middle East conflict. But our view here is that we do expect to see an eventual de-escalation of the Middle East conflict. Oil prices are actually now back to pre-conflict levels, 70 around there. Obviously, there will still be some volatility short term, but we do expect oil to return to these pre-conflict levels. And that could actually help to keep inflation manageable. In fact, we think that US inflation is likely to peak soon. And that will give the Fed less pressure to really hike rates.
If you're right about the Fed holding rates steady, that would be quite positive for currencies and markets in this part of the world, would it not?
Yes, because of the more hawkish Fed rate expectations that I think in some ways have also supported the dollar. The DXY was actually up about 3% year to date. Basically, the dollar has strengthened against the Asian currencies. But if the reverse were to happen, more dovish Fed rate expectations, that would make a softer US dollar, and that will actually be supportive for the Asian currencies.
And Asian markets might do quite well in the second half of this year?
Historically, Asian markets have tended to do well when their currency is strong. But yet today, first half, I think is a bit abnormal. While Asian markets as a whole did well despite the stronger US dollar. But if you look at the performance, the outperformers were really driven by the tech markets, tech-oriented markets, Japan, South Korea, Taiwan. China, we talked about it, has underperformed.
Yeah.
ASEAN markets, Singapore, Malaysia, holding up, but really nowhere near what we have seen in South Korea, the likes of South Korea and Taiwan. We believe that we could see a bit of the broadening in the second half. Less of the outperformance of the tech-related markets, and then the laggard markets, Hong Kong, China, I think there's an opportunity for them to play catch-up.
So that seems to be a good jumping-off point to talk a little bit more about Singapore's neighbouring markets. On the one hand, the Jakarta Composite Index has lost about 30% this year, and it's one of the worst performing markets in the world. On the other hand, as you mentioned, the Kospi has more than doubled this year, and the TAIEX is up nearly 60%. And in between those extremes, the Kuala Lumpur Composite Index has lost about 1%. It's about flat. And here in Singapore, the Straits Times Index has gained about 12%. For Maybank, these markets, Singapore, Malaysia, Indonesia, aren't just places to invest, but places where you operate your businesses and the home base of many of your clients. Would it be correct to assume that you have a somewhat different and perhaps longer-term approach to these regional markets than foreign private banks and wealth management advisors? And which ASEAN markets are you most bullish about right now?
ASEAN is not simply just an investment destination for us. It is actually a home to our business as a bank. We have presence across key markets in ASEAN, Singapore, Malaysia, Indonesia, Philippines, and we interact very closely with entrepreneurs, business owners, as well as investors in these markets. We actually support them in not just investments, wealth perspectives, but we also serve their business needs to help them grow their business. And because of that close interaction, we have very good perspective of the region. And that actually naturally leads us to take a long-term view. So when we look at ASEAN itself, we are focused on structural themes that could play out over the next 5 to 10 years. You're talking about rising household wealth, urbanization, infrastructure developments, supply chain diversification, digitization, so on and so forth. I think that will actually provide attractive long-term opportunities for investors as well as for business growth. But within the markets, Singapore, Malaysia, these two stand out for us. We are most constructive within ASEAN in these two markets.
Singapore and Malaysia.
Singapore and Malaysia. Well, Singapore, I think, have done well this year, right? I think it remains a beneficiary of very stable policy as well as political environment, benefiting from the safe haven flows and the policies that have been introduced by the government. I think that has also attracted more inflows into the markets, and that's supporting the valuation and the performance. For Malaysia, it has actually been doing quite well. Maybe year to date it was a bit flattish, but before that, I was actually doing quite well because valuation was attractive and there was some structural catalysts, including the likes of, say, Johor Singapore Special Economic Zone that actually helped to strengthen the intra-regional trade, which benefits actually not just Malaysia, but also Singapore. And as we speak, Malaysia is also talking about a value up initiative. Like Singapore, like Korea, like South Korea, like Japan, who talked about, trying to increase shareholder value, returns, improve corporate governance to really bring up the valuation of the markets. And therefore, we are constructive on these two markets. For Malaysia, they also have their own domestic program, National Energy Transition Program, digital infrastructure roadmap, data center developments in Malaysia. I think these also will help to support growth, both in terms of economy as well as corporate earnings. But in contrast, Indonesia, near term, a little bit trickier. It has underperformed, partly due to the fact that in terms of policy, I think investors are awaiting greater clarity around market-related developments, including the recent MSCI review. The latest MSCI review is saying that Indonesia, you're staying in emerging markets, not going to frontier yet, but we will review again later this year.
What is that catalyst that you need to see in Indonesia that will give you confidence that they will remain as an emerging market in the long term?
Well, I think the policymakers are addressing the issues that MSCI brought out in terms of information, transparency, flows, and incremental improvements. But we need to see a little bit more of that. Also on the domestic front, some of the recent policies, we also need to see more clarity, like for example, with regard to the export rules.
Which they've sort of reversed their position on that.
Exactly. But we need time to restore investor confidence that, hey, these policies is going to remain stable, it's going to be investor friendly. And then if they can show that, then that will help to bring flows back into Indonesia. Because for Indonesia, in terms of a longer term story, I think it's still pretty compelling. Young population, rising consumption, abundant resources. So if these factors are actually effectively utilized, that will make Indonesia a really great long-term story.
Basically, your view is to watch the trends, but stay diversified and stay invested.
But indeed, I think despite all the uncertainties that we've been discussing, right, from AI, geopolitics to inflation and rates, I think our key message remains unchanged. Markets will always face new challenges, but successful investing is rarely about predicting every headline accurately. It's more about staying disciplined, diversified, and focus on longer-term objectives, right? So at Maybank, I think our role here is really to help clients navigate the volatility with confidence and turn uncertainty into opportunity through thoughtful portfolio construction, as well as maintaining a long-term investment mindset.
That sounds like a good note on which to end. Eddy, thanks very much for being here today and putting up with all my questions.
Thank you very much for having me.
That's it for Mark to Market this week. BT Correspondents will be back next week with wealth editor Genevieve Kwa, who'll be talking about retirement and what it takes to achieve retirement adequacy. So please keep listening. This episode was produced by Howie Lim, Chai Pei Jia, together with our editor Claressa Monteiro, and it was written and presented by me. Thank you for listening. I'm benpaul.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.